There are two major investment strategy philosophies: active investment management and passive investment management. Both are very popular, and you'll find many heated debates on the subject of which strategy to use. Here's a great way to understand the basic difference. If we look at the S&P 500, one of the main stock market indexes for the US stock market, there are 500 companies that make up that index. Let's say that over the course of 1 year, the S&P 500 index overall was up 7%. A passive investment strategy would involve just owning the index. That means the investor would hold shares in all 500 companies in the same proportion that they are weighted in the index. So for example, if company XYZ was 2% of the S&P 500 index, then the passive investor would hold 2% of their portfolio in company XYZ as well. A passive investor could also just buy an S&P 500 index fund, which is designed to track the S&P 500 index. The investor would essentially get the same 7% return for the year minus the cost of the index fund. And index funds tend to be the cheapest type of funds to own. Let's say that they get a 6.9% return on the year after fees. All passive investors in the S&P 500 basically get the same return. Someone using an active investment strategy would try to outperform the S&P 500 in the hopes of getting a higher return than 7% for the year. Now, as a side note, another goal for an active investment strategy might be to get the same return for less risk. But for the purposes of this discussion, we'll just use the return comparison for now. In order to aim for a higher return, this investor may try to identify companies that they think will do the best out of the 500 companies to choose from. Of all the investors trying to beat the S&P 500, some will and some won't. Some might get a 10% return, some might get a 3% return, and so on. They may incur higher costs in the form of commissions if they are buying and selling often, higher investment fund costs. Active investment funds generally charge more than passive investment funds, and they may have a higher tax drag as well. Active investment management can be more time-consuming also. Some investors handle all their investment decisions themselves, and others use fund managers or services to handle the decisions and transactions for them. The same can be said for passive investment management. Some passive investors like to buy index funds themselves and get the lowest possible cost. Others are willing to pay a little bit more to get some help. Many investors use a combination of active and passive strategies in their portfolios. For example, some people might enjoy picking stocks from the Canadian stock market, but use index funds for exposure to emerging market stocks that they are not as familiar with. Some investors are dedicated passive investors. They might index all their holdings using low-cost index funds for Canadian stocks, US stocks, stocks from around the world, as well as their fixed income allocations. Lower costs are one of the major attractions for passive investors. One final note: active trading is a specific type of active investment management that tends to involve shorter holding periods for individual investments. An active trader may buy multiple stocks in a day and hold some for a few days and some for a few weeks, and so on. But it's also possible to be a buy and hold active investor. You might hold a portfolio of 25 stocks and not make any changes for years. This technically would be an active investment management style, as your holdings are different from the overall market or index. Generally speaking, when most people are talking about the difference between active and passive investment management, you can sum it up as this: active investment management is trying to beat the market, and passive management is trying to be the market.